Hello and welcome everyone to another market commentary from StashAway. As always, with me, my colleague and our co-founder and chief investment officer, Freddy Lim. Hey, Freddy, how are you?
Hey guys, I'm well. How are you doing?
Also well. Also well. I think hopefully we're on the getting closer to the finish line of being able to at least meet up for lunch or something at some point again soon. But I think we're getting there. Um, but yeah, hey, we actually got quite a lot of questions to go through today. So we're seeing a lot of eager listeners asking additional questions that we want to get to today. Before though, as always, we like to give a quick update on what's going on, right? And I think beginning of last week with the murder of George Floyd by a police officer, it sparked a lot of riots. And on top of, not that we already had the COVID-19 situation worldwide and cities closed, now we're having protests going on, there's looting going on and riots. How do you see this affecting the market? And especially, I think all of this week, the last, definitely Monday, Tuesday have been great for markets, right? So how can you explain that to the listeners?
First of all, the COVID-19 is not an issue for the markets, right? We have been explaining why the market will disconnect from the real economy, which is going to take some time to mend. So moving past the first point and into what's happening in the US last week, you got 5-6 straight days of heavy rioting. Trump has been showing a forceful stance, and that's attracted a lot of criticism from religious leaders, from black leaders, from everyone in the country. His disapproval rating is going up. It doesn't matter for the market because it can be viewed as a troublemaker being preoccupied with domestic issues. And the US-China trade war is taking a back seat now. So from the market standpoint, it's probably not a bad idea. And the price action that says otherwise.
So with the trade war then going on still, right? And China apparently making the rounds that they instruct the companies not to buy soybeans, right? You don't see this then as any more big escalation at this point.
Actually, you got to look beyond the languages on both sides. And firstly, on the US side, it's a lot of fire and fury in the statements, but nothing really is done. Even if you remove the trade status for Hong Kong, it's such a small share of China's re-exporting flow. It didn't matter. It only hurt Hong Kong more, but that means it's very localized, not regionalized. And on the flip side, the way China retaliated has been very intelligent. If you're holding soybean purchases and all that, but you're coming into a season where China is anyway seasonally unlikely not going to buy more anyway. So the pause actually don't mean much changes to what they usually do. So it's all seasonal bias. So if you look between the lines, nothing has really been fired across the borders. That's why the market stays firm.
Yeah, great update there and putting it into perspective from you there. Let's go over to the questions then. Since we did get quite a few, I want to get through as many as we can. For everyone else who's maybe listening for the first time, we do always take listeners' questions. So if you feel free to ask any of them in the comment section down below. And Freddie and myself will be picking those up over the next week or two. But let's get to the first one. It was Donovan Boone. He asked, I have been a StashAway customer for a few months now. The market has been going up, and there are rumors saying that the market is going to crash even more than the previous dip that we experienced in the month of March. How does StashAway going to plan ahead and do adjustments to our portfolios?
There's been a million or gazillion viewpoints out there, and the news flow has shifted from being a doomsaying bias towards something more neutral now. But for StashAway, we can't run a business or can't run an investment firm based on hearsay. What we're going to do is data driven. If data is lagging, we use the forward-looking prices that we can find. Now, prior to COVID-19, we certainly did not predict it, but mid-August, we have already re-optimized portfolio for greater uncertainties in global economies outside the US. that has really helped us navigate the COVID-19. And during the COVID-19, in principle, if you can't predict a crash ahead of time, you do not react to it belatedly. So we stick with that principles. And finally, in very recent weeks, and with a lot of recovery already realized, we finally re-optimize for the future. And in particular, we have planned ahead in terms of looking at how the massive stimulus is going to devalue the US dollars, how it's going to dilute the purchasing power of cash and paper money. And with regard to that big theme that we're seeing, we have reduced our US dollar exposure massively. We have also increased allocations to gold, which has worked well. It serves as a great portfolio insurance. So we have already ring-fenced portfolios defenses into the rally. So, planning ahead is something that we do all the time. But we got to take care of the fact that when you do adjustment, it's got to be for something serious, something cyclical, something with longer shelf lives. And we have done that. Remind me, Philipp, I'm wrong. It's about 2 weeks ago. We done a big re-optimization.
Yep, exactly.
Yeah. So we have already planned ahead.
Yeah, no, I think, and if listeners want to learn more also about, how Freddy looks at this in more detail, you can always sign up for our deep dive seminars that take a look at our investment philosophy that are led by Freddy. So if you ever want to sign up, you can find those seminars on our website when they're next happening. So if you want to learn more there. But you did mention gold, and I think that's a good transition to the second person's question, and that came from Jason Lim. So his question is, regarding the banking fractional system and gold standard, it seems that abandoning the gold standard was not as evil as some had made it to be. Had we remained in the gold standard, the economy might not have grown as much with the limited supply of gold. Am I right in this sense? If so, how about Bitcoin? With its limited supply, it may not cause inflation, but that will hinder future growth if it ever becomes mainstream.
Well, thank you, Jason, for the comprehensive and thoughtful question. Yes, you're right in the sense that the gold standard does limit the extent the money can multiply, and hence not every company who has a good reason to expand in good times can find the right borrowing channel to do so. So that's why we move away from a gold system, which has limited supply and scarcity. We have moved away from that to fiat paper systems. No systems is perfect. The fiat paper system is fractional, reserve. It could also invite its own sense of problems, right? So I just want to qualify that nothing is perfect. But yes, moving away from gold does allow for greater velocity in expanding an economy. Now, I would view Bitcoin as very different. It's not an asset per se. It's a utility token, which relies on the value of the network, the extent of the network, how sticky it is, how much people transact on the Bitcoin network, or what have you. So that's a very different thing. And there is scarcity by design with Bitcoin, and the halving of Bitcoin recently has helped the coin surge, right? However, by design, an asset class that's utility driven tends to be also proportionally more volatile than an asset-backed token. So I wouldn't go as far as to say that Bitcoin is a new gold, but I would say it is an interesting asset class on its own, but it's by design volatile. If you're interested in why it's volatile, feel free to look up McAfee law, METCALFE. McAfee law is a very good concept to apply to value networks, even for stocks such as Facebook, Tencent, Alibaba, or any platform with a huge marketplace, lots of dedicated users. There's a value in the network processing transactions. The McAfee law does say that any network will be proportionally square to the number of active users in the network, which means that they are by design going to be volatile. So mainstream or not is yet to be seen, the story. I won't comment more, but if you feel like you want to do a deep dive further in private, feel free to address your question again to my customer support, and I'm happy to have a one-on-one.
Yeah, no, thank you, Freddy, for taking this one. And I think if the listeners want to go back a few episodes, I think we've covered this before as well. So yeah, again, if you want to learn more, reach out. Before I let Freddy go and I let everyone else as the listeners go, just want to remind everyone of the next upcoming webinars that we're hosting. One is on the 11th of June. So that's Thursday in a week's time. That's going to be for our Singaporean audience. It's going to be how to invest the right way with ETFs. So if you want to learn more about ETF investing, you can attend that. As always, there's a link in the show notes below, as well as on our website. You can sign up for that too. For Malaysia, the next upcoming webinar is actually investing for women. So if you want to learn more as a woman on how to invest and how to take charge of your finances, you can join us on the 10th of June. That is next week, Wednesday, from 6 to 7 p.m. Again, the link to sign up is below this video, as well as on our website or our Facebook page, wherever you may interact with us. Otherwise, I hope you enjoyed, again, today's session. Feel free to leave your questions so we can pick them up next week. And otherwise, I wish everyone a good rest of the week, and see you next week. Bye-bye.
Subscribe to our YouTube channel to get notified whenever we have new content out for you. Also, don't forget to download the StashAway app. It's available in the Apple App Store as well as the Google Play Store. So you can start on your financial journey right now.